everything's okay and the markets don't even need rate cuts to keep going higher. That's the message that we're getting from the price action here. And of course, we're here to ask, does that make sense? Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we are going to have a look at what is an absolutely blistering week of economic event risk. The markets face back to back to back to back releases of very impactful, very top tier macroeconomic news this week. And they come into the week with a very interesting perspective on all of it in a very interesting setting. So we have both seemingly a massive rethink in the markets about what all of the key variables mean, and at the same time, an avalanche of new variables. So lots and lots to do here, lots and lots to look at and think about. So what we'll do first is we'll set ourselves a little bit of a framework for how we are looking at all of this, and just anchor ourselves a little bit in what's been going on and how what's been happening over the past several sessions is pointedly different from that. And then look at, in broad strokes, some of the event risk that is coming up this week. And then, of course, as these things occur, we are going to be looking at each one of them throughout the week. So consider this episode something of a stage setting exercise, because each one of these things is worth its own half hour, and we will certainly endeavor to do that on Macro Money as the week continues. We're, as ever, of course, here Monday through Thursday, which will give us the opportunity to review all of the key things in detail as the week progresses. So first, a bit of stage setting. It's surely no secret at this point that most of November and December was a story about the markets cheering the idea that the Fed is finally getting ready to cut rates, cheering the Fed's embrace of that idea, and the pricing out of aggressive interest rate cuts for 2024. We can see the way the stocks responded in the face of that adjustment. It is absolutely unmistakable. So we can see here from late October, early November, the S&P surging as rate cut odds build. So you can see here over the course of this period, we go from about 75 basis points, give or take, in cuts being baked in for this year. That's 3 cuts. And by the way, consistent with what the Fed is actually forecasting itself based on its own prognostications published in December. But the markets were of a different mind. They thought it was going to be much more. And so by the time we get to the turn of the year, we're talking about 6 cuts. So 1.5% in easing. And of course, what we've seen over the recent weeks is as this number stopped growing and started to kind of anchor, so too did stocks until Thursday and Friday of last week. And what we find here is not only is the stock of rate cuts declining, it's really pushing into levels we haven't seen in almost a month. And stocks rally anyway. So the S&P pushes to record highs. It's a similar story for the NASDAQ. And of course, as all of this occurs, the stock of rate cuts is diminishing, so yields are actually going higher. And although it's happening more overtly at the long end of the curve, because of course nobody is really expecting the Fed to hike, they're just expecting it to cut less. So the front end, the 2-year yield isn't really moving as aggressively as, let's say, the 5 or the 10 or even the 30-year. But there are pointed gains in particular at the 10-year benchmark level. So all of this to say, the markets are clearly saying, or seem to be anyway, we thought we needed 6 cuts to make it make sense that stocks are at these levels. And frankly, we've digested and we actually don't. We could go with 5 at this point. That's where we are at this stage, about 1.25% in easing. So we've shaved 1 cut away. That's fine. Stocks can go higher in that environment. And that's a pointed difference from the way that this dynamic has worked for at least 6 months, closer to a year. And so with that in mind, the event risk that we have this week comes at us at a time when the actual dynamics of how markets work here seem to be in flux. Now for this week's event risk, which is going to come at us and perhaps shape what this new narrative is. And if nothing else, the way that price action responds in the face of these announcements maybe gives us a little bit of a better clue as to what world we're living in now that this apparent transformation is afoot. So we begin in Japan. The much anticipated January Bank of Japan policy announcement is arriving in a matter of hours. It's going to be Tuesday morning in Japan, late evening in the US. And so overnight, as it were, if you're on Eastern or on Central Time, a little bit earlier, if, like me, you're on Pacific Time. And so what we're seeing here is very curious. We just said yields are going up because Fed rate cut odds are diminishing. That's not usually good news for the yen. In fact, the yen saw outsized losses all through the tightening cycle by other major central banks since basically the beginning of 2022, because, of course, the Bank of Japan did nothing. We likewise saw some soft Japanese CPI data, which should push back, or one might have thought would push back, on expectations that the Bank of Japan is looking for some sort of an exit from dovish monetary policy, a story that's been alive since late 2022, and something that we've pushed back on here at Macro Money, thinking the Bank of Japan is actually in no kind of hurry. This is the actual price action that we ended up seeing against this backdrop from the yen. The most critical bit of that being this right here. We, of course, saw the yen powering higher November, December, as those rate cut expectations were building, because, of course, the yen yields next to nothing, and the Bank of Japan was not expected to cut rates any further, any deeper into negative territory this year. Meanwhile, the other central banks are indeed expected to issue some degree of easing, be it the Fed or the ECB or the Bank of England, et cetera, et cetera. In that other central banks are starting to cut, but the Bank of Japan was going to maybe raise a little, but certainly not cut, there would be a narrowing of yield spreads in the yen's favor. And so one might think that higher yields, fewer cuts, would be something that would hurt the yen, and indeed it has. As we've had this unwinding of rate cut expectations since the beginning of this year, the yen has weakened. And then just as things were evolving to what may be a different dynamic last week, it stopped weakening. Perhaps the markets are arriving at the idea that whether the BOJ does anything or doesn't, whether there are 3 cuts from the Fed or 5, the reality remains the same. Bank of Japan isn't cutting. Everybody else is. That's a recipe for yen strength if yield differentials narrow, and narrow they should, just by less of a degree than speculation had it in November and December. How the BOJ sees this will then be absolutely critical. And of course, the relationship between the yen and global yields remains. So we see here those dynamics very much at work. Here are those global yields declining as Fed rate cut odds build. This is November and December right here. Here's the yen strengthening. Here's those rate cuts now starting to weaken. The resolve about them starting to ease up. The yen has turned the other way. But the overall inverse direction between the yen and global yields, obviously very much intact here. So how the yen responds to a Bank of Japan that is probably not going to say or do much of anything that's new should be very interesting. Remove the Bank of Japan and whatever notion of policy adjustment risk the markets are still holding on to out of the equation, and you end up with a situation where the yen is a pure yield story. If it then holds up as the Bank of Japan kicks the can down the road, we might well get a signal not just for the yen. We would also get a signal for what the markets think of global yields. That is, they expect them to decline. They see easing ahead. They maintain that it's going to occur. And they are perhaps signaling that this recent run in bonds doesn't have legs to it. So we'll see how this sort of a situation plays out. But in the yen's response, not only would we find the case for yen strength, if it holds up in the face of all these headwinds and continues to do so, even as the BOJ gives it a weightier headwind potentially to contend with, but also that the way the markets think about the yen here echoes the way they think about other things that are correlated as well. And so it might think then that a stronger yen speaks to a cap on yields. The next major thing that we're going to get is going to be a round of PMI data from the major economies. We're going to get this week the numbers out of Japan, Australia, the UK, the Eurozone, and of course the US. And it's the US one that we're going to be looking at most closely because clearly this is the driving narrative for the Fed and therefore for the sort of situation that we're seeing all around the financial system. In particular, we can see in these US PMIs, we have had a slow and steady US economy basically since August. We've gone virtually nowhere. Growth isn't falling. It isn't accelerating. The US economy is basically idling near standstill. From the market's perspective, this is a relatively good thing because what it means is rate cuts, but not so many as to be consistent with some sort of a recession, collapse, calamity sort of situation. Instead, the markets feel relatively good. It would seem that we're going to get some cuts. Growth will stay steady. It won't be so hot that the Fed needs to abort rate cuts. It won't be so weak that the Fed needs to cut aggressively, but of course, that would imply some sort of an economic crisis, or at least a deeper, more painful recession on the cards. As it stands, the composite index here is seen coming down to 50.3. That's within a hair of the 50 neutral line, where there is neither growth nor contraction. It'd be the weakest growth in 4 months, but again, well within this kind of standstill narrative. So if this comes in any hotter in a meaningful way or cooler, that sort of Goldilocks setting that the markets are embracing here may well be challenged. And then we'll see which way stocks default. If the number is too hot, they might become scared that the Fed could be more hawkish than they've anticipated. If it's much cooler than expected, well, then we might see a more defensive perspective where, in fact, bonds recover, the yen goes higher, yields back off, But stocks don't manage to capitalize on that. Because indeed, if the positive correlation between stocks and bonds is breaking down, it would work both ways. It would mean that stocks can go up even if yields rise, but it would also mean that stocks can go down even if yields fall. So it'll be an interesting thing to see how the market contends with any kind of deviations from this forecast one way or the other, and what that tells us about what the markets are thinking going forward. Another important barometer on U.S. growth comes to us from Canada. Now, not a lot of attention paid to Canada as a standalone, and in my mind, it is actually very important to follow, because what it is about as clear of an early window into the U.S. business cycle as there is. It is attached at the hip to the U.S. economy, and as we can see here by looking at the share of Canadian exports to the U.S., not surprisingly, really, close to 80% of Canadian exports are bound for U.S. markets. Now, if we look at the way that economy is doing, it is far less encouraging of a picture than meets the eye. And indeed, we can see here that between October and December, there was a very significant revision in policy rates to a more dovish setting. Now, that might be just echoing a similar adjustment for the Fed that is now, as we saw, being unraveled to some extent. In fact, it is very likely that the Fed is a very significant influence on these BOC expectations. But nevertheless, the Canadian economy, looking at their PMI data, has contracted now for 7 consecutive months. And that same data is screaming that new orders are down the most since the middle of 2020, at the heart of the COVID pandemic. Now, of course, the question becomes, well, whose new orders are falling? Well, if 80% of exports go to the U.S., that's U.S. demand that's falling apart. And so what the Bank of Canada says here, and to what extent they embrace this rate cut cycle that the markets have sketched out for them, and perhaps even build on that, should be a really telling window into U.S. economic condition. This is very much analogous to what happened in 2008. Some of the earliest indications that the U.S. Mortgage market crisis was spilling beyond U.S. borders. The markets, of course, at the time thought it was going to be contained and the rest of the world would be fine. Some of the earliest signaling that this was, in fact, a global crisis in the making showed up in Canadian data, because Canada is so very exposed to what happens in the U.S. So this might be a very helpful view to say, well, actually, maybe we need more rate cuts. And maybe that's not a good thing. Maybe what we're going to be looking at here is yields actually going down. But stocks are not going to be able to make good on that. Because if the dynamic has indeed broken, if the correlation is in fact over, as we say, it's broken in both directions. And it could very well be that U.S. yields can fall with stocks as opposed to the other way around, which is, of course, the story that we've been used to for really close to a year, if not more. From there, we go across the Atlantic over to the Eurozone, where we are also going to get a monetary policy announcement. Here, too, as we can see, a sizable dovish shift in expectations between October and the current settings. As we can see, both for this and for Canada, not really meaningful changes between those central banks' December meetings and the current setting. We can see here the December curve hugging very closely with the current one. Meanwhile, both mark a significant dovish adjustment from October's meeting. Now, the euro has been relatively anchored near recent levels. And the ECB has really tried to talk down easing speculation. Nevertheless, they are expected to cut to the tune of 5 times, with a significant probability for a sixth. The first cut is baked in no later than June, and the likelihood of an earlier one in April is non-negligible, to say the least, at about 68%. So when we look at that, the question, of course, becomes, well, if the ECB isn't going to do anything at this meeting, what's the guidance that they're going to give us? Those very same PMI numbers that we're going to get this week are probably going to reinforce the idea that the Eurozone is almost certainly in recession already. All of those numbers are going to be sub 50, looking at expectations. So while in places the regional economy will shrink at a slower rate, it will nevertheless shrink for yet another month. And so the growth story is looking very challenging. At the same time, the inflation story is looking like it's going the ECB's way. If we take a look at what's been going on with inflation most recently, the biggest contributor still very much food, and that's not anything that the ECB can do anything about in any kind of a direct way, but it has been helpfully declining over recent months. There's been a little bit of a pickup in headline inflation over the past 2 months or so, as we've seen the base effects from this negative influence of energy. This is the housing, water, electricity, and gas part of inflation that takes into it fuel cost. And of course, there were subsidies that distorted that as the Ukraine war broke out. And now we're dealing with the base effects of those subsidies getting squeezed away. As those base effects fade, the downside influence on CPI from them is fading also. So there's been a bit of an uptick in headline CPI just because this negative contribution has become smaller. But the overall story continues. And in fact, if we take food and the energy component out of the equation, headline CPI looks much closer, in fact, quite comfortably close to the ECB's 2% objective. So if, as the recession bites and inflation does what the ECB is thinking it should, the tone starts to change, and we get something that is a little bit closer to what is, if not an admission that rate cuts are coming, then certainly less of a striking defense of the status quo. If it seems like the ECB is settling into a tone and isn't building on its refusal to essentially acknowledge that the markets expect a meaningful easing cycle, as do economic conditions, as does the trajectory in inflation, if the amount of pushback at the very least doesn't increase, but seems to be waning a bit, that's going to weigh heavily on the euro. It might also give us a story about the business cycle. Again, warning that maybe things aren't as rosy as the markets have it. Then, of course, finally, we are going to close out the week with some heavy-duty U.S. economic data. First, the GDP report. It is expected to show a climb down from the third quarter's runaway jump of 4.9%. We're going to come back to earth here at 2.3%. By no means a bad number in the grand scheme of things for the U.S., well within the range of normal, and echoing this kind of slow and steady picture that the markets like to see. We are also going to get the Fed's favorite inflation gauge, the PCE index, and the story here very much of the same sort of flavor. The headline PCE expected to hold basically unchanged at 2.6%, but the more important bit, the headline, less food, less goods, which has been essentially squeezed to next to nothing, less energy, looking at just service sector inflation, where price growth has, of course, ended up being a lot stickier. And so the area that the Fed is almost exclusively focused on, this is showing some encouragement, it would seem, with a slide down to 3%. For the core index, that's the lowest since March of 2021, suggesting that indeed what the Fed is doing is working. Inflation continues to make some progress in the right direction. And what we end up with is, again, this reinforcement of a slow and steady dynamic that the markets seem to be cheering here. Now, looking at the way that U.S. economic data has performed relative to forecasts suggests that basically since August, U.S. data outcomes have converged on expectations. This is according to data from Citigroup. And so what we end up with then is the likelihood that this data does, in fact, register relatively close to forecasts. The question, of course, is what is the lead into all of this, and what does that mean? Well, if these numbers register pretty close, then the amount of rate cuts now on the table, 5, is probably about right. Or so the markets might reason. That, of course, would set the stage for something of a butting of heads with the Fed, which thinks 3 is more accurate, and which has, of course, left the door open to doing less if need be. So as we look at what all of this means, the most interesting part going forward will be how the U.S. data actually influences markets. What will be the price action response if this data deviates meaningfully higher or meaningfully lower? What the market default is if it doesn't? Do we get any kind of a strong directional conviction move out of these numbers if all they do is leave things as they are? Because, of course, next week, we get the Fed itself. And how these numbers shape what this new world that we're apparently entering looks like, should be very telling for how the markets will then respond to what will be the quintessential piece of stage setting for what happens next, the FOMC policy announcement. Because, of course, that will give the clearest view yet on will we get a cut in March, how many cuts are coming, and what that means for markets writ large. And that is macro money for today. We are, of course, going to, as I mentioned earlier, unpick each one of these things in more granular detail as the week progresses. We're here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we look at what happens on Wall Street on a given day and what that might mean going forward. Back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call Sundays, writing for the news and insights portion of tastylive.com, now front and center on the freshly redesigned tastylive.com website. Go check that out. It's looking very good. And opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. See you for the rest of this week as we continue to track these things and see what they mean. Happy trading. Take care.